Stop scrolling. This REIT could pay you steady income while you sleep. If you're hunting for reliable dividends, property-backed stability, and a REIT that's still dishing out a juicy 6.4% yield, then you need to know about MPACT. It owns VivoCity, Mapletree Business City, and premium properties across Singapore, Hong Kong, China, Japan, and South Korea. But here's the real question. Is MPACT a hidden gem for passive income? Or is it quietly bleeding from overseas risks? Smash that like button so more Singaporeans learn how to build cash flow from smart investments. Hit subscribe to Wealth for You. If you believe your money should work harder than you do, and stay till the end. We're breaking down valuation, dividends, interest rates, and whether it's a buy right now. Disclaimer. This video is for education and entertainment only, not financial advice. Always do your own research or speak to a licensed advisor before investing. Chapter 1. What are REITs? First things first. What exactly is a REIT? REIT stands for Real Estate Investment Trust. Basically, it's a company that owns income-generating properties, like malls, office buildings, and warehouses, and pays out most of the rental income to shareholders like you and me. It's kinda like being a landlord, but without the leaking toilets, midnight repair calls, or dealing with tenants ghosting on rent. REITs let you earn passive income from property without actually buying any property yourself. Pretty neat, right? Chapter 2. How MPACT was formed. Now let's zoom in on MPACT, short for Mapletree Pan-Asia Commercial Trust. This REIT was born in 2022, when two major players in the Singapore REIT space came together. Mapletree Commercial Trust, focused on Singapore assets, and Mapletree North Asia Commercial Trust, with properties in North Asia. The result? A regional heavyweight with a diversified portfolio spanning Singapore, Hong Kong, China, Japan, and South Korea. So now, with one REIT, you get access to some of Asia's biggest markets, plus iconic assets like VivoCity and Festival Walk. Chapter 3. What properties does MPACT own? MPACT isn't your average REIT. It owns a massive portfolio of 17 high-quality commercial properties, collectively valued at around 16 billion Singapore dollars. Total lettable area? A whopping 10.5 million square feet. That's like fitting almost 190 football fields worth of office, retail, and business space. Let's break it down by geography. In Singapore, this is MPACT's crown jewel. It holds 4 key properties: VivoCity, Singapore's largest shopping mall and a retail magnet; Mapletree Business City, a premium Grade A business hub in the Alexandra district; M Tower, a well-located office property with rising occupancy; and BOAHF, Bank of America Harbor Front, which is 100% leased. Together, these form the most stable income base in the entire portfolio. Over in Hong Kong, there's Festival Walk, a major retail and office development in Kowloon Tong. Despite retail headwinds, it maintains strong occupancy and shopper traffic. In China, MPACT owns Gateway Plaza in Beijing and Sandhill Plaza in Shanghai. These are modern office assets in prime locations, though recent years have seen softening rents and increased competition. In Japan, there's a collection of 9 office properties, mostly in Tokyo, Yokohama, and Chiba. The standout is that most properties are stable, but the Makuhari submarket in Chiba is facing tenant exit risks in 2026, which management is actively addressing. And in South Korea, there's the Pinnacle Gangnam, a sleek, Grade A office tower in Seoul's Tech District. It's been a bright spot, achieving near full occupancy and strong demand from new tenants. So in short, MPACT gives you access to diversified income streams from some of Asia's most important cities. But with that comes currency and market risks too, especially outside Singapore. Up next, let's see how well these properties are performing in terms of occupancy and rental growth. Chapter 4. Occupancy and rental reversions. So, how well are MPACT's properties being used? Well, overall portfolio occupancy is around 90%, which is actually pretty solid, especially in a challenging economic environment. Let's break it down a bit. Singapore assets are the standout here. VivoCity, MBC, and BOAHF are all running at very high occupancy, close to 100% in some cases. And here's the kicker. VivoCity recorded a 16.8% rental uplift on lease renewals. That means new tenants are paying more rent than before, which is always a good sign. Now, what about the overseas assets? It's a bit more mixed. In South Korea, the Pinnacle Gangnam is performing well with 99.9% occupancy. Over in Hong Kong, Festival Walk is still holding up, but tenant sales dipped slightly due to economic softness. In China, occupancy fell a little because of slower leasing in Beijing and Shanghai. And in Japan, there's been some pressure from non-renewals in Chiba, bringing occupancy down to about 80%. So, in short, Singapore is really MPACT's anchor, reliable, cash flow generating, and well occupied. The overseas portfolio offers growth potential, but also comes with more risk, whether it's leasing challenges or currency headwinds. Coming up, let's look at the latest financial numbers and see how all this translates into investor returns. Chapter 5. Latest Financials. All right, let's talk numbers. Because at the end of the day, performance pays the bills. For the financial year 2024 to 2025, MPACT reported revenue of about 908.8 million Singapore dollars, which is down 5.1%. Net property income, or NPI, came in at 683.5 million Singapore dollars, a 6.1% drop, and distribution per unit, or DPU, fell to 8.02 cents, about a 10% decrease from the year before. So, what happened? There were two main factors behind the dip. First, Mapletree Anson, a prime Grade A office in Singapore, was sold. While the sale helped strengthen the balance sheet, it also meant one less income-generating asset contributing to revenue. Second, the Singapore dollar strengthened against other regional currencies, like the Japanese yen and Chinese yuan. This made overseas earnings look smaller when converted back to SGD, something all regional REITs are dealing with. But here's the good news. Despite the drop in revenue, MPACT's operating and finance costs actually improved. Lower borrowing and tighter cost control helped soften the blow, showing that management is actively managing risks and expenses. So, while the top-line numbers took a hit, the fundamentals are still holding up. Chapter 6. Valuation Metrics. Now here's where things get a little spicy, for all you value hunters out there. Let's take a quick snapshot of how MPACT is priced in the market right now. The market cap is around 6.7 billion Singapore dollars. The price-to-earnings ratio sits at about 11.6 times earnings. The price-to-book ratio is just 0.7 times. Gearing ratio is 37.7%, which is healthy and below the regulatory ceiling. And return on equity is around 6.2%. Now let's decode that for a moment. A PE of 11.6 times means investors are paying 11.6 years' worth of earnings for the stock, below average for REITs, suggesting it's not overhyped. But the real attention grabber? The price-to-book ratio of 0.70. That means you're buying 1 Singapore dollar of net assets for just 70 cents. Imagine walking into a store where everything is 30% off, but instead of shirts, you're buying buildings. Even better, gearing is well managed at 37.7%, leaving MPACT some room to borrow if needed, while staying financially sound. The ROE of 6.2% is modest, but acceptable for a REIT, especially one focused on income over aggressive growth. So what does all this mean? MPACT is undervalued by traditional metrics. It's not trading at premium prices like some retail REITs or US-listed peers. Instead, it's quietly sitting in the value bin, waiting for patient investors who know how to spot a bargain. Let's now move on to what you're probably most curious about: the dividends. Chapter 7: Dividend History, Yield and Reliability. Let's talk about what income investors really care about: dividends. MPACT pays out dividends quarterly, and right now it's offering a yield of around 6.4%. That's comfortably higher than CPF's 2.5% or even Singapore savings bonds at around 3%. Sounds pretty sweet, right? But here's the catch. Over the past couple of years, DPU, distribution per unit, has been declining. In FY 23-24, the DPU was about 8.94 cents. In FY 24-25, it slipped to 8.02 cents, a 10% drop. So what's behind the dip? Well, there have been fewer rental contributions after the divestment of Mapletree Anson, currency headwinds with a strong Singapore dollar eroding income from overseas properties, and leasing challenges in markets like Hong Kong and Japan, where tenant demand has been weaker. Now, let's be clear, this doesn't mean the dividend is collapsing, but it does suggest that dividend growth isn't guaranteed, especially in today's high interest rate environment and slower rental growth landscape. So, is MPACT's dividend still reliable? Yes, for now. Most of the dividend is backed by stable recurring rental income, particularly from strong Singapore assets like VivoCity and MBC. Management has been disciplined, avoiding reliance on one-off divestment gains to top up payouts. And with a solid base in Singapore, cash flow remains relatively resilient, even as overseas markets wobble. That said, it's still smart to monitor the trend. Because if foreign income continues to weaken or interest costs rise, DPU could come under further pressure. In short, the yield is attractive, but watch the quality behind the numbers, not just the headline. Chapter 8: Future Outlook. Looking ahead, MPACT isn't sitting still. Management has laid out a focused strategy to strengthen the trust in a challenging environment. Here's what they're working on. Upgrading VivoCity. A fresh round of asset enhancement is underway, especially in Basement 2, to refresh the retail experience and attract higher-spending tenants. The upgrade is expected to boost both shopper traffic and rental income. They're also managing costs and refinancing debt. With 80% of their borrowings on fixed rates, MPACT is actively managing refinancing risks and keeping a tight lid on interest expenses. Plus, they're working to improve tenant mix, attracting more resilient and diversified tenants, especially in overseas markets where office demand is shifting. That said, the road ahead isn't all smooth. Challenges remain, particularly in Hong Kong, where consumer sentiment and retail sales are still under pressure. China, which is seeing slower than expected economic recovery, and Japan, where leasing in certain markets like Makuhari faces non-renewal risks. Plus, currency volatility, especially a strong Singapore dollar, could continue to weigh on overseas earnings when converted back. In summary, MPACT is taking the right steps to future-proof its portfolio, but it still needs patience and careful execution to ride out regional market headwinds. Chapter 9: Interest Rates and the Fed. Let's talk about interest rates, because if you invest in REITs, this matters a lot. REITs like MPACT borrow large amounts of money to buy and maintain properties. So when interest rates rise, their debt becomes more expensive, and this can squeeze profits and potentially lower the distributions you receive as a unit holder. That's why many REITs have struggled over the past 2 years, with the U.S. Federal Reserve raising rates aggressively to fight inflation. But here's the good news. In the June 2025 Fed meeting, the Fed held rates steady. No hike this time. Even better, they hinted that a rate cut might be coming as early as July, if inflation continues to ease. So what does that mean for MPACT? A potential Fed rate cut would likely lower borrowing costs over time, ease refinancing pressure, and possibly improve distribution per unit as interest expenses go down. In short, if rates fall, REITs benefit, and MPACT could see some breathing room in the quarters ahead. Chapter 10. So, should you buy MPACT in 2025? All right, let's tie it all together. MPACT has a lot going for it. It owns strong income-generating properties in Singapore, like VivoCity and Mapletree Business City, that form the solid core of its portfolio. It's also trading at a discount, with a price-to-book ratio of just 0.7 times, which suggests potential value for patient investors. On top of that, the 6.4% dividend yield is attractive in today's climate, and management has shown that they're actively recycling capital and managing debt well. But of course, it's not all sunshine and rainbows. Its overseas markets, particularly in China, Hong Kong, and parts of Japan, are still facing headwinds. And while the dividend is still funded by recurring income, the DPU has declined slightly, reflecting the pressure on cash flows. Plus, broader REIT sentiment remains cautious, thanks to high interest rates and tighter investor wallets. So, is now a good time to buy? If you're a long-term income investor who believes in the resilience of Singapore's economy, and you're looking for stable, property-backed passive income, then yes, MPACT could be a solid addition to your watch list or portfolio. This isn't a REIT that's going to double overnight. But if you're after a defensive dividend payer with long-term upside and you believe rates will come down later this year, MPACT just might be worth your attention. So, what do you think? Will MPACT make it into your income portfolio? Let me know in the comments below. I'd love to hear your take. And if you found this video helpful, smash that like button so more Singaporeans can learn how to grow their passive income through REITs. It really helps the algorithm share this with others who need it. Don't forget to subscribe to Wealth for You and tap that notification bell so you never miss simple, practical investing content that actually works. And hey, remember this? You don't need to be rich on paper. What matters is being cash flow rich, with income that supports your goals, your lifestyle, and your freedom. Until next time, happy investing, and may your dividends keep flowing.